All right, everyone, good evening. Today is Tuesday, October 13th, and we're going to walk through the market news of the day. All right, to kick things off, we saw falling equity markets across the board, with the S&P 500 falling the most, falling 60 basis points. Now, and the Nasdaq fell accordingly. Due to weather conditions out in Asia, the Nikkei and Hang Seng did not trade out east. Treasuries rallied with yields down a little bit more than 5 basis points over at the long end, and two COVID-19 drug trials have now been halted on safety concerns, with Johnson & Johnson now saying that it was pausing all trials of its experimental COVID-19 vaccine after one participant developed an adverse reaction. This is the first leading drug maker to test a single dose COVID-19 vaccine in phase 3 trials. However, it has been stopped. AstraZeneca stopped its trial in September when at least one participant developed unexplained neurological symptoms, which obviously is incredibly problematic. Trials have been resumed for the AstraZeneca drug everywhere outside of the United States, using adenovirus to deliver the immunizing protein to the body. Eli Lilly said on Tuesday that they were also halting its antibody treatment, which is very similar to the one taken by US President Donald Trump. So, not surprisingly, that was the biggest driver of equity markets today. And we've seen a little bit stronger movements in the growth side with the NASDAQ slightly outperforming. All right, moving on. Eyes on earnings. So there was a huge blowout in bank earnings, obviously not enough to move the entire markets upward. But if we look to JP Morgan, their shares were down a little bit less than 2%, despite reporting results that shattered Wall Street expectations. The bank posted third quarter profits of 9.44 billion US dollars, or 2.92 a share, exceeding the 2.23 expected by analysts. Revenue numbers were up across the board to 29.94 billion, which is about 2 billion more than what analysts had expected as well. Also, they had reduced their loan loss provisions by $570 million, which is not surprising coming out of banks being very conservative in the quarter two numbers, where they wanted to be more careful about the tightening credit environment and the questions that could possibly entail with that uncertainty. Also on your screen, you'll see Citigroup. Citigroup on Tuesday also beat analysts' expectations this morning, posting a $3.2 billion profit. Again, we still see continued expensive credit costs ahead of that management transition that they're about to have, with Michael Corbat retiring and Fraser coming in, being the first woman CEO of a major Wall Street firm. Earnings were $1.40 a share versus 93 cents expected, so huge outperformance on the EPS basis. And revenue was 17.3 billion versus 17.2 billion expected, so a slight outperformance there. However, if you go deeper in the numbers, the trading groups within the sales and trading department did incredibly well, which is not surprising given the volatility. However, Citi outperformed other banks in this regard. The fixed income trading yielded revenues of nearly 4 billion, while equities raked in nearly 900 million US dollars in sales. This in comparison to expectations of 3.5 billion and 851 million, respectively. This makes it the third largest US bank by assets, so obviously a big player. And the bank also last week did agree to pay that fine of 400 million US dollars for failing to address the quote unquote several longstanding deficiencies in its risk controls. BlackRock, also in financial services, had its stock climb substantially, given that earnings were absolutely outstanding. They were up nearly 6% to $651 in pre-market trading. This, again, is the world's largest money management firm. So they recorded third quarter earnings that jumped nearly 30% to $9.22 a share, up from $7.15 a share a year earlier. Obviously, BlackRock does have the iShares ETF platform, so they do have a huge premise in products that retail investors like to touch. In addition, analysts on average had expected earnings of $7.77 a share, so it was substantially above there. Inflows into their funds totaled 129 billion, representing 9% of annualized organic base fee growth, according to CEO Larry Fink on the earnings call today. 50% of the long-term flows were actually generated by investors outside of the United States, with investors in Europe and Asia. So we see the global platform really exuding. On the bottom of your screen, you'll see Delta and J&J. Delta Airlines reported a massive 5.4 billion US dollar loss in the third quarter after spending billions on buyouts for employees and restructuring its fleet. Obviously, it's an airline. Airlines are not in a great situation right now, given the cash burn, the cost of sanitizing, and the, I guess, changing consumer demand, both from the business front and the travelers that are just traveling for pleasure. In addition, J&J is the company that obviously had their vaccine trial stopped today. However, they did report great earnings. Not surprisingly, though, the vaccine trial being paused did take precedent in terms of an earnings reaction. All right, moving on. Got 6 stories to talk about. The first thing we're going to talk about is Apple's new iPhones. They announced new 5G iPhones, including an $800 iPhone 12, $700 mini, the $1,000 Pro, and the $1,100, iPhone Max. So this is Apple's biggest product introduction of the year and the first major redesign of the popular handset since 2017. Apple's also unveiling $50 Beats headphones that will be sold in exchange for leaving iPhone boxes empty with respect to the headphones. So they're no longer going to be headphones inside the box, but they will sell a cheaper option. Evergrande also raised $550 million US dollars in reduced placement to pay debt. So this is the equivalent of Hong Kong dollars 4.3 billion. So this is an offshore funding for a Chinese company. Like we mentioned about a week ago, Evergrande is the world's most indebted developer, debt to EBITDA running above 10 times. They sold 260 million shares at 16.50 a piece in Hong Kong dollars, representing a 15% discount to its last closing price in Hong Kong. So this is a junk-rated property behemoth, and they're raising funds as their debt pile is a little bit more than 120 billion US dollars. So they're raising more funds to try to get out of that hole that they've put themselves in. Nearly 6 billion of that 120 billion of debt is maturing in the next 2 months. So this is a very urgent thing at hand. BAML, Credit Suisse, Huatai, and UBS are the joint book runners for this deal, and the developer is down about 31% from its 15-month high reached early July last year. All right, in the middle, top middle, we see AMC's liquidity issue. AMC is weighing bankruptcy right now, and this comes after advisory work with Moelis in early July, where the cinema chain AMC nears financing its deal to avert the near-term bankruptcy. Obviously, they raised debt to get out of the problem at hand at the moment, which just kind of kicks the can down the road. So the company is close to choosing an offer. Or in July, the company decided to choose an offer from Silver Lake as opposed to different proposals from Apollo, Kempner, and Ares. So that was a choice that they had made in July, but they still could, however, run out of money by the end of the year, and published a filing today saying that liquidity will be largely depleted by the end of the year or early next year if attendance doesn't pick up. And it is exploring actions that include asset sales, again, not surprisingly, since they need to raise cash, and joint ventures. Given the state of the world, state of moviegoing, and both restrictions and consumer changes, it's unlikely that demand will go back to what it was pre-pandemic for a while. Attendance since the resumption of business is down a little bit more than 85%. So even though things are open statutorily, it doesn't mean that people are actually going. To touch on the bottom middle, we see that the oil rally loses steam as hopes fade for the timely U.S. stimulus. Oil nudged lower in Asia, staying around $40 a barrel as dimming prospects for another round of U.S. fiscal stimulus before November's elections really did decide to continue to erode that upward momentum. Again, we've been seeing a trend of a strengthening dollar in the very, very near term, coming off of a medium-term trend of weakening. So as the dollar strengthened, this did, not surprisingly, diminish the appeal for commodities that are priced in the dollar, like WTI futures contracts on oil. We have also seen fresh pressure from both Saudi Arabia and Russia with regard to other OPEC members sticking to agreed output curbs. OPEC Plus producers are still planning to ease output cuts by 2 million barrels a day in January, and refining margins due to continue to deteriorate, which bodes poorly for oil prices as it becomes less profitable, obviously, for refineries to actually go through the production process. So we see a combined refining margin for gasoline and diesel falling towards $9 a barrel on Tuesday. So that is very low. Definitely makes it hard for these refineries to stay open and even harder for them to thrive. Equinox lenders have decided to organize. This is the big gym founded in New York City and definitely hip, upscale, very popular. They own SoulCycle as well. They have tapped the Akin Gump for debt talks, which is a big law firm that works with the reorganizations. They are holding close to a majority of Equinox, roughly $1 billion loan, and did bring in these legal advisors today. The New York-based gym operator is facing this February 2021 deadline that we had mentioned a couple episodes ago to repurchase certain debt tied to its SoulCycle spin studio train that it had acquired. Not surprisingly, again, same story as AMC. They're hampered by lockdowns and see a huge issue in terms of being both allowed to reopen and consumer demand once they do reopen. Chains including Gold's Gym International, 24 Hour Fitness, and New York Sports Clubs, the parent company, Tom Sports International, have sought bankruptcy protection in recent months. LA Fitness International is also weighing different options for a capital raise. Equinox itself has a $1.02 billion loan due in 2024, which has been trading about 78 cents on the dollar. But obviously, if they're bringing legal advisors, then that market value might be a little bit out of date. Again, one thing to note when you're looking at the prices of corporate bonds is that they're typically very illiquid, both because of the size that you need to trade them. And then once you go down into the high yield scope, it's so much smaller of an investor universe. So these prices can be very out of date and won't necessarily react right away to changes in the conditions and changes in the legal atmosphere. And the last thing on your screen is that there is a fix for the $345 billion US LIBOR dilemma in a debt swap. So the Federal Farm Credit Bank Funding Corporation is looking to exchange the securities due between 2022 and 2023 that do lack language to account for the end of LIBOR. A lot of notes that are out right now do lack this language, which is really important because LIBOR is supposed to end at the end of the year in 2021. And it'll be switched over to SOFR. And that becomes a problem when there's nothing in the indenture that specifies what to do next. So this deal is managed by TD Securities, and the FFCB exchange offer began on September 24th and is set to expire at 5 p.m. New York time on October 22nd. So the FFCB raises funds by selling debt to banks, insurers, and state and local municipalities, and then provides the loans, leases, and other services to different rural communities and other agriculture businesses. So hopefully, if this is able to get through, they are able to execute this debt swap. This will provide the adequate background and foresight that other companies can use and other firms can use in exchanging their own notes. So that pretty much covers it. I look forward to seeing you Monday for our next market discussion. Yeah, thank you so much for tuning in.